Hello, I'm Kamal Basra, and on behalf of Tracy Themes and I'd like to welcome you to Sophia Wealth Academy, the virtual editions of Wise Money Talks. Today's topic is called A Market Update, the Art of Boring. And what we'll delve into is how to construct sound, resilient portfolios amidst all the short-term market noise that surrounds us. The aim of Sophia Wealth Academy is to educate, inform, and inspire you. And we hope that today's talk will help in that regard. Before we get started, I would like to take a moment to bring your attention to the two buttons at the bottom of your screen. The first is the chat button, and the other is the Q&A button. We will have a question and answer session at the end of our speaker's talk, so please type in any questions you have during the session into that question and answer box so that we can take your questions. In the chat box, if you could introduce yourselves and also list where you're calling in from so that we can have an idea of where our attendees are from. And also, one final note is that this webinar is being recorded, and we will send you a link by email in the next couple of days. So with that, we're ready to get started. And I'd like to introduce you to our speaker for tonight. Neeraj Jain is a member of the institutional client management team at Mawer Investment Management Ltd. Prior to joining Mawer, he was the head of institutional business development at CGOV Asset Management and focused on institutional clients, Indigenous communities, and consultants in Western Canada. He also worked at AGF Investments as the head of institutional global client service and began his career in investment management research, working at AIMCO and Mercer Investment Consulting, which provides advice to large pension plans. Neeraj earned a Bachelor of Mathematics degree from the University of Waterloo, and he is a Chartered Financial Analyst, or CFA, charter holder with investment experience since 2003. And as if those credentials weren't enough, he is also a father of 6-year-old triplets. So with that, Neeraj, welcome to tonight's webinar, and I'll pass it over to you.
Well, thank you very much for the introduction, Kamal. And yes, the triplets certainly keep things interesting and unpredictable. And in a lot of ways, the market is very similar to a 6-year-old or 3 6-year-olds, as the case is, and that it can remain irrational over the short term and be heavily influenced by emotion and not economic reality. Good evening, everyone, and thank you for joining me here today and for taking time out of your evening. Over the next little bit, I'm going to discuss the current market, as well as one of the biggest questions that's out there that will have a large impact on the market over the next number of years, and how we at Mawer navigate all of that noise. And I look forward to a good Q&A session at the end. But before we begin, I wanted to start off with a quick poll to find out where you get your investing information from. So you'll see that it popped up on your screen, and the different options are investment advisor, friends and family, newspapers and media, social media, e-newsletter, and I don't currently get any financial information. So please enter your response. Okay, the results are in. So about 2/3 or 64% get their advice from an investment advisor, 0 from friends and family, which is probably a good idea. You never want to have those awkward conversations over Thanksgiving or Christmas dinner. Newspapers and media, 18%, 0 social media, 0 e-newsletters, and about 18% is none. So thank you for that information. Even at Mawer, we get a lot of information via what we call scuttlebutt, which is getting information from various sources. And we're talking to companies, we're obviously talking to management, but we're also talking to their competitors, their suppliers, current employees, former employees. So there's no bad sources of information. You just have to be aware that everyone's going to have a different angle in terms of what they're trying to get across. So why don't we jump into the market and kind of what's been happening. A lot has changed over the course of a year. You know, we're all pretty familiar with COVID-19 now, which started in Wuhan, China, likely in the second half of 2019 before spreading to the rest of the world. And in order to mitigate the spread of the disease, countries shut down large parts of their economy and disrupted supply chains around the world. And a lot of companies faced a cash crunch. So what happened? Well, the economy had a heart attack. What you're looking at here is the monthly purchasing managers index by country for the manufacturing sector. And what's important here is that green represents economic expansion and red is economic contraction. So as you move from the left to the right, what you see is the heart attack that became apparent in March, April, and May, the very dark shades of red, before we began to recover. And what helped to facilitate that recovery was that central banks and governments acted very swiftly. There was three main things that they did. First, central banks, they cut interest rates. Second was they started buying back bonds or engaging in what's called quantitative easing. And that's straight out of the 2008-2009 financial recession playbook. However, in addition, they were also willing to buy corporate bonds, and this injected stability into the financial systems and the credit markets. And third, governments unleashed a tremendous amount of fiscal stimulus, which is different than in 2008 and 2009. They directly supported both businesses and individuals, and they spent a lot of money. And we can see on this chart is that they've spent trillions of dollars on COVID. Estimates are that it ranges anywhere from 5% to 20% of GDP, depending on the country. And this added materially to debt burdens, and it means that we have to work our way out of this debt at some point. You know, has all the spending taken us back to normal? Well, we're not there yet. For instance, in Canada, the unemployment rate was still 9%, and it's unclear how much more governments are willing or able to spend to offset these future stresses related to COVID. One silver lining has been that interest rates are very low. And the chart that you're looking at here is the Canada 10-year yield going back to 1990. And the trend is clear. It's been lower for longer. So currently, the 10-year Canadian bond yield is 0.6%, which is actually better than a lot of countries in the world that are negative. So you look at countries like France, Germany, and Japan. If you invest in a government bond there, you're actually paying them interest. You're guaranteed to lose money. And one of the unintended consequences of low interest rates, which is a bit perplexing given the economic gloom, is that low bond yields and interest rates support the valuation of all other asset classes. Capital flows to higher returning asset classes, and that supports valuation. And that's why you've seen valuation support the stock market as well as housing prices. One of the main reasons why interest rates have been falling is because inflation has been falling. So inflation, where has it gone? This chart looks at the past 40 years, and it's clearly been trending down since its peak in the early 80s. And here's the big question that's out there. Will all the stimulus create massive inflation or not? And there's hardly any question that carries greater weight in economics right now, or that divides the financial world more sharply than whether inflation is on its way back. One camp is convinced that the no expense spared fight against COVID-19 has put developed economies on course for rising prices on a scale we haven't seen in decades. The other one says that the virus is exacerbating the conditions of the past dozen years or so when deflation rather than overheating has been the big threat. And we just saw this past summer that the European numbers that came out, well, it was showing deflation across Europe. And that's one of the main reasons why the European Central Bank may increase quantitative easing. And this debate, it touches every area of policy from trade rivalries to unemployment benefits, and everyone has an interest in the outcome. Governments and central banks will face pressure to curtail their pandemic relief efforts, already worth over 20 trillion according to the Bank of America. If they trigger a spike in prices, workers and consumers will see the impact in wage packets and household bills. More than 40 trillion of retirement savings is at risk of erosion if inflation returns. So for now, the jury is out. Some countries reported a drop in prices early in the crisis and a jump more recently. In the bond markets and among consumers, measures of expected inflation have edged higher, but the data will ultimately settle the question that could take years to trickle in. And over the next few slides, I'll present some of the main arguments, both for and against the return of inflation. So here's where I want to take another poll just to get your thoughts on whether you think that inflation or deflation will be prevalent over the next 5 years. So the choices are inflation, deflation, or more of the same, or status quo from what we've seen the last number of years. So please go ahead and put in your response. Okay, so the results are in. About 60% feel that we're going to see inflation over the next 5 years. About 13% think there'll be deflation, and 27% expect more of the same or the status quo. Okay, well, let's see what the arguments are both for and against inflation over the next number of years. So the case for, there's a lot of money out there. Inflation is always and everywhere a monetary phenomenon. Free market economist Milton Friedman famously argued that point. And that's still a widely held view, and those who hold it are pointing to the wave of money being created by governments to fight the pandemic, and predicting that sooner or later it will wash through the whole economy and push prices up. In many countries, money supply is growing at some of the fastest rates on record. What's more, unlike a decade ago, when a similar infusion of money never moved much beyond banks' balance sheets, there are signs this time around that the crash is making its way into pockets of consumers and companies. Okay, the case against, but it's not circulating. So it's actually the use of money, not just its creation, that affects prices. And that's one explanation for subdued inflation since 2008, even as central banks cranked up their printing presses. In the US, the velocity of money, or the frequency in which it changes hands as people use it to buy goods and services, fell off in the 2008 financial crisis, having never really recovered, and has collapsed to unprecedented lows today. Okay, the case for government support of households. Spending may bounce back faster than it did after 2008 and drive prices higher because more aggressive policy response has cushioned the blow to household finances. Propped up by central banks, stock markets have taken months instead of years to recover. Home prices didn't take much of a hit at all. And lower down the income ladder, governments have provided substantial support to workers who got furloughed or fired. Fiscal stimulus, unlike monetary kind, goes directly into people's bank accounts where it's likely to get spent. Companies with any market power to raise prices will likely do so. And if you're like me, you probably noticed that in your personal life, anything from food to childcare, anything from recreational activities like bikes and kayaks, or even lumber to do any household improvements, all saw material increases in prices. Okay, the case against: not everyone is spending. So incomes may have held up through the recession thanks to the government intervention, but not all that money is getting spent. Saving rates have soared. In the second quarter, it reached over 20%, and you can see that it's never been higher historically. In fact, even today in the news, they were talking that the US consumer, just given the pandemic and not traveling to work and not being able to spend on restaurants and vacations, have about $2 trillion of disposable income to spend. Now, as I mentioned, that's partly a function of the lockdowns and not being able to spend that money. But even as economies reopen and consumers have more options, worries about health and work could mean they don't spend all of it right away. The case for low interest rates. So one reason why many analysts expect high inflation is simply because central banks, the guardians of price stability in the low inflation era, are more than willing to let it rise. The Federal Reserve made that official back in August by announcing a new strategy that requires it to be more tolerant when prices overshoot and refrain from preemptive interest rate increases. So the Fed's focus has essentially committed to keeping rates low for the foreseeable future. In fact, they've gone as far as saying, don't expect any interest rate increases until at least 2023, so 3 years from now. The European Central Bank has embarked on a similar review. Accommodative monetary policies have been tried before in the campaign to gin up inflation, and we've fallen short. What's new is that central banks are now committing to make up for some of the lost inflation during downturns, i.e. what that means is they're willing to let it run past that 2% target that's been the stable for many different central banks globally. Even in Canada, the Bank of Canada is asking for feedback from Canadians on its inflation target guidelines, which have been in place since 1991. Given the Fed's move, it could foreshadow what we could expect from other central banks globally. Okay, the counter argument: employment and the lack of it. So policymakers, they've worked with a rule of thumb that assumes that some kind of trade-off between inflation and unemployment, known as the Phillips Curve. The idea is that prices will only face sustained upward pressure when the economy is using all of its resources, including labor. And doubt has been cast on the strength of that link. Still, if there's any connection at all, then it should ease concerns about inflation. Employment everywhere has slumped, and with little prospect of a quick rebound to pre-pandemic levels. The case for supply shocks. There's already evidence that disruptions to supply chains are pushing prices up. In China, for example, food inflation has been accelerating in the last couple of months, and a squeeze on imports because of the pandemic is one reason why. The long run risk is that the virus will escalate tensions like the ones behind the US-China trade war. Governments may become more reluctant to rely on other countries for strategic goods, such as masks and medicine or computer chips. And they could pressure businesses to bring manufacturing back home, even when it's more expensive. Okay, last one. The case against spare capacity. The fight against COVID-19 has often been compared with an actual war, the kind of disaster that historically has triggered inflation. But there's an important difference. Military conflicts wreck the supply side of the economy, like factories and railway lines, leading to bottlenecks and shortages that push prices up. The coronavirus has left those facilities intact, even if they're not being used right now. So in a pandemic, it's the demand side that takes the main hit. Capital is not destroyed or depleted, so it's easier to end up with excess capacity. So that's a lot to take in. There's a lot of good points for inflation, a lot of good points why things may continue as they are, or we might even see deflation. And with all that said, at Mower, we embrace uncertainty. We don't know what the future holds, Well, we try to put the odds in our favor to understand what a company is worth. And we don't believe in a single point valuation being intellectually honest. We know that our forecasts are going to be wrong. It's very unlikely that a revenue growth assumption of 5% over the next 5 years will turn out to be precisely that. And so what we do is we seek to isolate those variables that are most important or have the greatest sensitivity in terms of driving the intrinsic value of a company. So these can differ from business to business, but they're typically things like revenue growth, margins, or your working capital assumptions, to name a few. And we'll make a base case forecast for each of them. Again, say revenue growth is 5%. But what we also do is to understand how these variables can fluctuate. So for example, if management is really able to execute, or if a competitor falters, then maybe revenue growth could be as high as 10%. Alternatively, if competitive intensity lifts or if a new entrant takes market share, you could see revenue declines of minus 10%, for example. So when we run our model, we don't just run it once, rather we run the model thousands of times through a Monte Carlo simulation, treating all the variables stochastically and allowing them to fluctuate randomly between the parameters that we set. So that's a long-winded way of saying we run the model thousands of times to end up with what you see here on this page, which is a histogram or a probability distribution. So here, our model is saying that 90% of the time, the value of this company is somewhere between $40 and $54. That doesn't mean the company can't be worth zero. In fact, we would say any model that you produce that doesn't have an outcome of potentially zero is likely flawed. Every company in a different situation or different scenario could actually go under. But in our particular case, we're ascribing a 5% probability that it's worth less than $40. So this gives us a sense of the odds. So what do we like to do? We like to buy companies when the current price is toward the left-hand side of the distribution, when the odds suggest that we're getting it at a discount to intrinsic value. So there's less downside, more upside potential. We'll tend to trim or eliminate positions as the price moves to the right-hand side of the distribution. That means there's potentially more downside risk and less upside potential. But if we're buying wealth-creating companies, this entire distribution should shift to the right over time. So nothing is set in stone. The future is inherently uncertain. And the focus here is putting the odds in our favor. So once we have the valuation piece, well, how do we figure out how much of that particular business we should own in our portfolio? So what you see here is what we call our portfolio matrix. And when I look at this, I always think of the game of Battleship, and I'm probably dating myself a little bit depending on what demographic is watching this video. I don't know if many people play that anymore, but on the vertical axis is our assessment of a company's quality. So that's based on their business model and management. And on the horizontal axis, it's that return potential. So essentially, that's the piece that's run out of the histogram on the previous slide. And you'll notice that we don't have any companies in the A1 box. A1 would be the best, but it's difficult to find these. Lots of high quality companies exist, but they tend to be more expensive. So A1, I hope you can see my mouse, here's in the top right, would be the highest quality, but it would also mean it has the highest return potential. And as our deputy CIO often states, it's pretty hard to buy a new Porsche at the price of a Kia. Conversely, D1 here on the bottom would be a lottery ticket. It means that there's a high return potential, but we have no confidence in the business management or the business model. So Halma, if you can see here, is in the box A3. That's a good example of a company that we've owned for over a decade in our international equity fund. And it used to be all the way over here to the right in the A2 box. And as other individuals discover the virtue of their business, it's slowly been moving to the left. And as it's done that, we've been slowly trimming our position over that time. I should mention on this page, each of the color bands represents a different conviction level. So if a stock is in the dark blue, that would be that we could own 4 to 6% weights. If it's in that medium blue, we're in that 2 to 4% range. And if it's in that light blue, it's 0 to 2%. And if it's anywhere outside of that, well, we're not going to own it. And what we like about this model is that it helps with the sell discipline. It keeps emotion out with the visual representation of the entire portfolio. Each person on our team scores a company independently, and then they compare it on a quarterly basis. And the idea there is to find out where the biggest differences. Maybe someone's rating a company A2, so high quality, very good valuation, but maybe someone else has it as a B3, kind of medium quality and good, but not high valuation. So the objective there is to have a discussion to figure out what are the differences that you're each seeing and come to a conclusion from a portfolio construction standpoint. The other thing you'll see on here is that there's no reference to benchmarks on this slide. When we're looking at companies, we're looking at them on an individual basis on their own merits. At the end, what we're trying to do is construct a diversified, resilient portfolio of generally fair valued, higher quality companies. These are the types of businesses that not only protect capital in down markets, but come out of economic shocks even stronger. So on this slide, at least historically, we've been able to put the odds in our clients' favor. Over the past 10 years, our balanced fund has protected capital in falling markets due to our focus on wealth creating companies, but these same companies have been able to execute and also outperform in rising markets. So maybe just to explain the numbers, when you have a down market capture of 80%, what that means is if the market falls 10%, you're falling 8%. So you're not losing as much capital in those down markets. Conversely, in a rising market, you can see here it's 116%. So again, what that's saying is when a market is up 10%, we're up 11.6%. And it's not going to be true day to day, week to week, month to month, but over the long term, the types of businesses that we own have this return profile. And you might be wondering at this point, what type of companies do we own? And the answer is, for the most part, boring ones. And I'll get to that in another couple of slides. When we think about the first half of 2020, it's been a tale of two halves. In Q1, by the end of the quarter, we had doom and gloom and the energy collapse and global lockdowns. Global markets were hitting multi-year lows. In Q2, we saw the opposite. Ultimately, in the tug of war between the virus, stimulus, and economic fundamentals, optimism prevailed. And in Q3, we finally had a more balanced quarter without any wild swings in performance. So, what did we do with our portfolios? Well, in the first part of the year, we trimmed our bank positions. They tend to suffer more during periods of lower interest rates. We decreased our positions in businesses where debt and access to liquidity were of greater concern. Though most of our funds already had low exposure or no exposure to energy based on the nature of the way that we invest, we reduced our energy exposure even further. Conversely, we emphasized internet or software-based businesses that should benefit from the behavioral shifts accelerated by the economic slowdown as well as the pandemic. And effectively, this is where growth is being pulled forward. So an example would be NetEase. They're an online game developer in China, and e-commerce giant Alibaba, as well as we continue to build our position in a company called Adyen, which is a European-based payments processor. We put a premium on businesses with more stable defensive demand, companies like Saputo or Bunzl. And we reduced credit exposure within our Canadian bond fund to improve liquidity while retaining positions in high quality issuers. And finally, we opted for patience from an asset mix perspective. As during the global financial crisis, we did not fight the downward drift in equities. So before I get into the types of businesses that we have in the portfolio, I think it's important to understand what do we look for at Mower. And hopefully you've gotten a sense of that over the last 30 minutes or so. is that because we're long-term business owners and we're bottom-up investors, we're looking for three simple things: wealth creating companies, great management teams, and a fair valuation. So what is a wealth creating company? It's pretty simple. It means that you can generate a return on capital greater than your cost of capital by some sort of sustainable competitive advantage. So for example, if you can go to the bank and borrow money at 3%, turn around and reinvest it at 5% over and over again, well, by definition, you have a wealth creating business. Management teams, the reason why we care about management so much is that if you have a wealth creating business, you're generating a lot of cash, and you have to decide what to do with all of that money. Do you pay down debt? Do you pay a dividend? Do you make an acquisition? Do you reinvest in the business organically? So all of those decisions tend to compound over time for wealth creating businesses. And then finally, as I mentioned earlier, we look for companies where we think we're getting them at a discount to what we believe their intrinsic value is. So what types of companies are those? Well, you can see that here. On this slide, what I'm showing here are the top 10 holdings for a cross-section of our funds. In our international equity strategy, our Canadian equity strategy, as well as our balanced fund, which includes US companies. And if I start with the international equities on the left-hand side, just a few examples from our top 10. Aon, they're an insurance broker and a human resource consulting firm. They don't take any underwriting risk. They're essentially just matching up their clients with the underwriters. Wolters Kluwer, it's probably a company most of you haven't heard of, and it's one of the more boring company names we have in the portfolio. And what they are is they're a periodicals publisher. So they provide information to tax and accounting individuals, healthcare professionals, as well as individuals in the legal and regulatory area. Bunzl, they provide food and retail packaging, cleaning supplies, and safety products. Air Liquide is the second largest industrial gas company in the world. Suhura Holdings, they're essentially the Japanese version of Shoppers Drug Mart in Canada. When we look at the Canadian portfolio, a lot of these names are probably pretty familiar to most of you. One of the companies that we occasionally get questions on is Shopify, and how do we justify owning Shopify in our portfolio? And the way we think of that is that 2030 is now in 2020, and we've pulled forward a trend that was already occurring. Now, Shopify, unlike Amazon, where it serves consumers, Shopify helps merchants in a channel agnostic fashion. So they can sell through any medium via Shopify. They're growing internationally as well as beyond the English-speaking world. They built their base on tiny companies. Now they're going for large companies. Growth of e-commerce overall has been a big boon for companies like Shopify. And beyond consumers, business to business could expand into restaurants and other verticals. So when you think about that valuation histogram, companies like Air Liquide that are essentially a utility-like business will have a very narrow histogram. So we have a pretty good degree of confidence knowing where it's going to be. Shopify is going to have a very wide distribution. And if we think back to the financial downturn earlier this year, we looked at Shopify's valuation range. We got a range anywhere from $150 all the way up to $1,500. And at the time, the stock was trading at around $300 a share. So again, we don't know where the future is going to go, but what we do know is that based on our valuation and the thousands of different scenarios that we ran, there was likely more upside potential in the name than downside risk. So it's one of the names that we were adding to during that period. And maybe just to end off on current themes, as we've often stated many times before, the world is uncertain. As we close out the final quarter of 2020, our base case is likely a period of positive but slower economic growth, thanks to an accommodative monetary and fiscal environment. I spoke to a few developments that help make the case for the inflation scenario. And the biggest threat to low inflation is likely central banks. Primarily, it's their willingness to have inflation trend higher. Historically, it's been unwise to ignore these messages from central banks. And while inflation is something that we're watching closely, we see this as a potential medium-term risk. Just because the Fed says they're willing to tolerate inflation over 2%, there's no guarantee they can actually generate that to occur. And although growth has rebounded, the majority of the growth has been fueled by fiscal support, and we're still at record unemployment levels. There are more people unemployed today in absolute terms than at the peak of the great financial crisis. So this suggests that the rebound is very fragile and not sustainable without government support. Therefore, in the near term, we see deflation as a more probable risk. Technology adaptation continues to accelerate. Canadian businesses that have already benefited from this may continue, such as I mentioned Shopify, Granite REIT, and potentially even Loblaws, depending on how they adapt their grocery pickup options online. And the key for us is using our process, building out our discounted cash flow models, which is that histogram I spoke to earlier. And it's not about looking at multiples. You often hear people say a stock has a price to earnings multiple of 50 times. Well, we don't look at that. We think probabilistically about the fair value range based on what their cash flow potential is over the next 15 years. So as long-term investors focused on company fundamentals, we believe our best course of action is to play the plan, be prepared, stay diversified so that our funds are well positioned for multiple outcomes. We adhere to our investment philosophy, keep our ideas flowing, and culture intact. And in these ways, we believe we create resilience. So with that, I'm finished the formal part of the presentation, and I'll pass it back to Kamal.
Thank you, Neeraj. A lot of information that you covered there. Before we get to your questions, and again, I'll remind everybody to type in your questions in the Q&A box located at the bottom of your screen, and we'll have Neeraj answer some of those. Wanted to bring your attention to our next webinar, which is the Yoga of Money, and that's on Saturday, November the 21st at 9 a.m. And please check out and register on the sophiawealthacademy.com website if you would like to participate in that. And for the questions, Neeraj, I thought I'd ask you the first one, which is, how does Mawer decide when to rebalance and when to increase holdings in, let's say, Canada versus the US versus the world?
Yeah, thanks for the question. If I step back and I think about a balanced fund, we use a 60-40 approach. So 60% to equities, 40% to bonds as a long-term asset mix target. And over time, we have found that 60-40 target asset mix has been very resilient. And as I mentioned earlier in my presentation, even when the equity markets were declining back in Q1 and early in Q2, we actually didn't stray too far in terms of an asset mix decision. You never want to fight that falling knife. And over time, we found these type of events tend to be quicker in nature. So we tend to stay pretty on course with what we see. We don't tend to make drastic asset mix changes at an overall level. From a country-specific level, we have tended to favor non-domestic or non-Canadian investments over the last probably 7 or 8 years now. And that mainly just has to do with the breadth of options available in Canada versus going globally and internationally in general. In Canada, we still have a lot of domination in the mid and large cap space by financial companies, by energy companies, and even material companies. Gold is back to being 10% of the index. So it's a very narrow benchmark to invest in. And that's even exacerbated even more within Canadian small caps, where you tend to see a lot more of those micro energy and mining companies. So we've tended to favor international over the last number of years.
Thank you. And another trend is, I get asked this a lot from clients as well, and it's a question about the green revolution, or the trend towards clean energy and away from fossil fuels. And also, I've noticed in more portfolios over the last couple of years, the energy holdings have decreased substantially. to where now it's very little, if any. Can you speak to that a little bit, please?
Sure, I'd love to take credit and say that we were early adopters for the green energy trend, but unfortunately, it's not the case. The lack of energy exposure really goes back to the types of businesses that we want to invest in. We generally tend to favor what we call capital light businesses, so companies that don't need a lot of money to dig things out of the ground. So energy companies, they spend a lot of money on exploration and production, and they're also affected by a commodity price that they have absolutely no control over. So for those reasons, to your point, we've generally been zero weight internationally within energy companies. In the Canadian sleeve, we do have some exposure, but even there it's limited. It's around 5%, where the index is nearly triple that.
Perfect, thank you. And when is the best time to invest? So when does what type of markets do you invest in? What type of markets do you look for to trigger those purchases?
Sure, well, I would say from our perspective, any time is a good time to invest. You're always going to have volatility. That just comes with the inherent nature of being invested in the equity markets. The key there is just being invested in the right types of businesses, having that diversified, resilient portfolio that can do well in any different economic outcome. Internally, we often talk about being in two places at once. It's one of the reasons why we typically own 50 to 70 companies and why we don't only own 20 or our top 10. We want to make sure that in different scenarios, and I spoke to inflation versus deflation, well, we have both types of companies in our portfolio. And if you think about what's happening today in the markets, the last few days since Joe Biden has won, you've been seeing a rotation out of technology companies and into more cyclical companies. And one of the reasons that's been happening is that technology companies are considered what we call long duration, meaning that their cash flows go out well into the future relative to companies like Air Liquide that have cash flows right now on a quarterly basis. So if your expectation is that there's going to be future inflation, that's going to be rising interest rates as well longer term, and that's going to have a much larger impact on those long duration companies, such as technology companies that have a lot of cash flow out into the future. So it's about having that right balance. From an individual perspective or an individual investor, I would say it really depends on your personal situation. And that's where I would say go talk to your financial advisor and make sure you're doing what works for you, given your financial situation.
Perfect, thank you. Another question is around government debt, and you talked about that. All around the world, there's stimulus packages and support and a lot of money being put into the marketplace, whether it's to individuals or to corporations. And the question's around, is there any risk to our social safety nets, Canada Pension Plan, old age security, programs like that with the current scenario of money being sent out?
Yeah, that's, I think we're in a very fortunate position in Canada where CPP has their actuarial evaluations on a regular basis. So they're actually, it's absolutely fine. We're all going to get our CPP pension. It's kind of been guaranteed for the next 75 years, so at least in our lifetime and potentially our kids' lifetime as well. But there's always a risk with that. But one of the benefits of having lower interest rates is that even with all the additional debt that a lot of countries are taking on, as interest rates have come down, the cost of servicing that debt is actually decreased. And I talked, for example, about some of the European countries that are issuing negative debt, and that's a whole other topic. So I won't go too deep into that. But essentially, they're getting paid to lend money out to investors. So right now, it's not an issue. Longer term, if we do get that scenario where we have high and rampant inflation, it could definitely be an issue if interest rates have to rise and rise quickly. But today, from everything that we're seeing, we don't see that as an issue, just given the fact that debt servicing ratios are still very low and accommodative. And
that sort of ties back, so thank you for that. That ties back to the name of the presentation, which is The Art of Boring. And I think sometimes investors feel that there has to be frenzied activity at all times in portfolios in order to be successful. And I think Mawer's investment philosophy, which you've outlined today, speaks to the fact that it's about analysis and knowing what you're looking for, and then figuring out how to find it, and having those processes in place. Do you want to speak a little bit about that, about chasing returns, or trying to get the next Bitcoin or Zoom stock in your portfolio, which I notice you don't have?
No, we definitely don't have that. We don't have a lot of other high-flying tech companies in our portfolio either. For us, it really comes down to that quality aspect. You want to have quality business models. Those are models that can be resilient in different types of economic scenarios, whether it's economic expansion or economic contraction. But also, more importantly, it's about thinking about the long term. You don't want to make irrational short-term decisions based on what's happening today. I started off the presentation by saying markets can be inherently irrational and have its temper tantrums. And there's that saying that markets can be irrational longer than you can be solvent. So the key is that you want to think long-term. You don't want to get caught up in fads. You want to make sure that you're buying high-quality businesses. And it kind of goes to that turtle and hare approach, right? We all know the end of that story and how the race was won. And as you saw from our performance history there, that's indicative of all of our different strategies at Mower, that taking that slow, disciplined approach is a winning approach. It has been for many years. And when I think about our portfolio turnover, maybe that's another way to answer the question. It's very low. Typically, for most of our portfolios, it's anywhere from 10 to 20% a year. So we're not making a lot of changes. And I highlighted a company like Halma that we've owned for over a decade. And it's gone up, it's gone down over that time, and we rebalance the weight to adjust accordingly. But when you have those type of good quality businesses, you want to stick with them over the long term.
And I think I hear you speaking to the analysis piece, and moving away from the emotion and basing your decisions on the strategies and on the analysis, so that you're not reacting on an emotional basis when we go through a period like we did in February, March, where the markets went down. But it's hard for individual investors to remember that and to stay rational, and because it feels scary. In the midst of it, it feels like we should be doing something. And with the discipline, I think maybe the answer to that is a little bit to do with discipline, is know the strategies that are in place and then have confidence and do nothing.
That's the best thing about having a boring portfolio is that, markets, at times of market turbulence, you do is you just close your eyes, you don't look at your portfolio statement, give it a couple of quarters and know that you're going to be okay when you come out at the end. What you don't want to do is make drastic decisions during those type of economic events. We've seen that happen before, not with us, but in general with other folks. And yeah, it can lead to more heartache than if you just left things alone. So if you're diversified, if you have the right asset mix that suits your situation, then you should be fine.
And you also talked about cash flow and net worth, and that's something that Tracy and I constantly emphasize in financial planning, is when you're looking at your own cash flow versus net worth, one being immediate needs and the other being long-term wealth accumulation. And you alluded to it on the corporate basis, on a company by company basis, is how management chooses to use that cash, whether it's for increasing cash flow or decreasing debt or creating more investment into factories and hiring and all of that. With all the government stimulus, do you have a sense of what companies are doing with that money? Is it going towards, some individuals are, which is paying off debt rather than spending it, and buying a new car at this time?
Well, it's interesting. If you look at the general markets pre-COVID, a lot of companies were doing stock buybacks. So they were just buying back their own shares. And a lot of times they were issuing debt to do it because debt has been so cheap to get in the external market. Generally, the types of companies we look at is we like companies with low debt. We want companies that are disciplined, that are paying it off, but more importantly, that are reinvesting that capital in wealth creating opportunities. And that's the key, is you want management teams that know what to do with that money. And if you're just buying back your own stock, well, you potentially run out of ideas. in terms of how to generate more wealth. So that's something that we pay keen attention to. But generally, we like to stick with companies that have low debt and are reinvesting for the future.
Perfect. Thank you. We've got another question coming in that is regarding Vancouver's, Neeraj, you're in Toronto, and the housing prices in Toronto are similar to Vancouver. And this is a question around, you know, if I have some money, some funds, should I be considering purchasing a property versus a portfolio? And I know how I would answer that, which is it depends. It depends on what your situation is and what the rest of your finances look like. It's very hard to answer a question like that. But any thoughts around real estate valuations and portfolios?
Well, you took the words right out of my mouth. Yeah, it really does depend on your personal situation. Everyone's going to be different. It just depends. Yeah, on really just depends on your situation. If you're living in the house, it's a primary residence, that's a consideration. If you're looking at it as something as an investment over the next 30 years, well, you know, we don't know again what the stock market's going to return, but over the last 30 years, you've gotten a pretty healthy return on an annualized basis just by being patient and investing in the markets. Obviously, we're a little bit biased, being investment manager, so I would say go ahead and put it in the market and invest over the long term. But it ultimately does depend on your personal situation and what works best for you.
Perfect, thank you. And we'll have one more question before we end off. One of the limitations is, as a Canadian investor, it's very difficult to invest in companies that are abroad, that are globally based. What areas of the world do you invest in?
Great, and you know what, I actually have a slide that I'll flip to. Right here that shows all the different types of strategies that we invest in. So our investment approach and philosophy is global in nature. You can see that we invest in Canada, large cap, small cap, internationally, emerging markets. Essentially, if it's a public equity, we invest there, given our approach. So we're pretty broad based. If people have an interest in the different funds, I would say, you know, we're available through an SMA platform, or we're also available through a mutual fund series. But again, talk to your financial advisor and determine what's best for your unique situation.
Perfect. Thank you very much, Neeraj, for joining us tonight and for being part of our Wise Money Talk series. And that gives us a real insight into what is behind the portfolios that we see that managers build, and some of the hard work and the process that's involved in choosing what's held in the portfolio, when it's purchased, and then more importantly, when it's sold, which is a really hard and tricky piece to navigate. We know you're in Toronto, so it's almost 10 o'clock there. So again, thank you very much for your insights and your knowledge. And we look forward to, we'll also say goodbye to our audience. And thank you for joining us tonight. Check out sophiawealthacademy.com for future webinars, and we'll see you soon. Bye-bye.
Thank you very much for having me.